Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. Last week, we discussed a lot of the risks that were concerning us in the overall markets, that we thought it was prudent to now become much more defensive. And we're going to build upon that case a little bit. And we have a really interesting chart of the futures markets that I think you'll find kind of disturbing. Also, we mentioned last week that we do have a new purchase in the biotech space. It's an obesity drug. I think you'll find it really interesting. It has huge upside potential, so we're kind of excited about it. So, reviewing some of the risk of the overall market. So, think about risk management. Again, we think it's prudent to be more defensive right now than offensive. So we think in the second half of the year that it's likely we're going to slip into a recession. So the Federal Reserve has to do something to stop the slow momentum in the overall economy. And the inflation numbers are preventing the Fed from cutting rates, at least currently. So we think that the economy will go into recession in the second half of the year. Japan and Germany, number 3 and number 4 economies in the world, have entered in recession. The valuations of the stock market are in kind of bubble territory. They've moved above 20 times earnings, roughly 20.7 or 20.8 times earnings. So the last time we were at this level, the market got to roughly 24 times earnings, forward earnings, in that 1999-2000 period. So valuations are a problem in our opinion. The concentration of ownership in technology is a problem. Technology, if you pull Google and Meta and Amazon, you put them where they belong in the technology sector, you're up to about 40% in technology. So that's as high or higher than what it was in 1999. So the market's very concentrated in names that I would consider to be risky. The market technically is extended, so it's overbought in a big way. The bullish sentiment is high, speculation's high. If you compare the stock market to the bond market, stocks are overvalued by 15 to 20%. And the Fed can't do a whole lot about it. You know, the market's been expecting rates to come down. The rates need to come down on the 10-year Treasury, which are roughly 4.3%, down to about 3.3% to have a fairly valued bond versus stock market. So the Fed is kind of stuck where they are because inflation's a little sticky. We saw that last week. So the inflation numbers were a little higher than expected. On the services side of the economy, those inflation numbers are a little bit more sticky. So we don't think that inflation goes away until the economy goes into recession. So it really is still going to stick around for a while, inflation, until the economy actually recesses. One of the things that's kind of new that we looked at here recently is that the margin debt has crept up. The margin debt's up about $100 billion from where it was 12 months ago to about $700 billion. So $100 billion increase. Who is borrowing money at 12% to buy stocks? It's kind of nutty, in our opinion. So there's a report out from the Commodities Future Trading Commission. It's called the Trader in Financial Futures Report. So there's 4 sections to the report. One of the sections is about asset managers and their holdings of futures contracts. So the net position is roughly $270 billion in the futures market. So this is in the 99 percentile. So you can only go up one more percentile, right? So it's a very high level for these managers to own so much of these futures. So you can see here how volatile this is. And when it gets to be volatile, that's when markets correct. So we're at a very high level. There's only one direction it can go from this level, and it's down. So if you look at that 2022 level, where we had that significant bear market, we were probably off roughly 27% from high to low. We're at a similar level, maybe even higher than that level. So a major decrease in the futures contracts could very quickly filter its way into the stock market. That's a lot of money, $250 billion of value. That's a lot of money. So it could have a very quick, pronounced impact on the stock market. When I saw this, I'm like, ooh, that is not good. So this came from Nomura Securities. I think it's a really interesting chart. It's really of thinking about. Put that in the front part of your mind. Nvidia reports on Wednesday. So Nvidia is a critically important report for the stock market. As you know, the stock market has been driven by the mega caps tech stocks rolling out artificial intelligence. The first part of the rollout is to buy the capital equipment needed for it. So that's what's occurring. So listening to the big four, Amazon, Google, Meta, and Microsoft's earnings calls, all four companies plan on doing major capital spending, buying the hardware, building, upgrading the data centers so they can do these large language searches called artificial intelligence. So that's what's happening. Nvidia is expected to report over $20 billion in revenues, just over $20 billion in revenues. We think the whisper on Nvidia is roughly $23 billion in revenues. I kind of think it doesn't matter what they're going to report. The stock's likely to go down. That's what's concerning us. And you can see here, here's when this is back in their first surprise back in May of last year, when they came out and said, instead of $6 billion for next quarter, we're expecting $11 billion next quarter. So that was a major guide up in revenue. And the following quarter was a good quarter, but the stock traded off. Rather than going up like it did the previous quarter, it traded off. Now, going into this quarter, so the last quarter reported, they had a reasonable quarter, good quarter. The stock traded down. And then we had this massive move in the overall stock market and a lot of focus on artificial intelligence, and the stock went berserk to the upside. So the market cap of Nvidia is now $1.8 trillion, and the implied volatility in the stock is about 11%. So if you do the math on that, that's roughly $200 billion of volatility. That's about half the market cap of Walmart. You can't make this up. It's a crazy large number. So just remember, Nvidia really is a semiconductor design company. There's competition coming at them. So you have Intel and AMD developing their own chips. And also there's $100 billion of venture capital money being put to solve this problem, to come after Nvidia. So, enjoy the rally while it lasts. We're concerned that when they report, the stock comes down. If it drops $200 billion, that's going to force a lot of the other technology stocks down as well. That could be the peak of the market, at least in the short term. So there's another point that we'd like to make on this. Generally, the sell side, it takes them about 6 quarters to start to get the earnings estimates right. So this will be the 4th quarter. So we're kind of at the tail end of the earnings surprises. If they can't get the numbers right by now, it would surprise me. The labor market. So we've been puzzled by this. The labor market's been really strong, and obviously the labor market holds up well until we have a recession. And then we look at the average hourly hours worked per week. They've been dropping. It's been dropping like we were in the recession of 2008, 2009. So you can see in the chart here, this is 2008, 2009. It dropped probably less than what it's currently dropped. So we're having a bigger drop than what we had during that recession. So companies are effectively laying people off, but they're doing by the number of hours that people are working. They're keeping the employees around, but they're cutting their hours back. So the next step is when we do go in recession, you're going to see probably a lot higher unemployment than what we currently have. It's just a data point that we picked out that we thought was interesting to share. There's no way to make money off of this, but it's just another data point that's pointing towards a slowdown in the second half of this year, a recession second half of this year. So the new biotech stock that we have, Veru, this is really interesting. The stock is roughly trades between 40 and 50 cents. It was as high as over $20 not too long ago. So looking at the obesity space, you have two drugs that have been approved in the space by Lilly and Novo Nordisk. These are two GLP-1 drugs for obesity. So what happens with these drugs is, say you're a 260-pound person, you lose 60 pounds. Well, roughly half of that 60 pounds is going to be muscle. So you have to go on a really strong weight training program to retain your muscles. Otherwise, half of what you lose is going to be muscle. So when you go off the drug, people very quickly gain back the weight that they've lost. So either you stay on that drug for life, which is probably not the right thing to do because there are side effects, or you get off the drug and the issue is you go back to weighing 260 pounds again, but you don't gain the muscle back, you just gain the fat. So if you're elderly, all of a sudden it's a major health risk to you to gain all that fat back because you don't have the muscle. So a Veru's drug is used to, it signals your muscles to grow. It's different than a steroid, which has major side effects, but it has this drug has no side effects. It signals your muscles to grow, and you do lose some weight with it, so it's a good dietary drug to take. But it offsets, the muscle mass that you would lose by taking these drugs. So we think it's a highly important drug in the overall obesity space. If this is a $100 billion space, we think this drug could be a very large drug over time. So the market cap of this company is roughly $70 million. We believe that they will have good results when the phase 2B is released at the end of the year. So you go from phase 1, phase 2. This is an additional phase of phase 2 because they've already tested this drug extensively for breast cancer. They decided to move it from breast cancer over to the obesity space to get a very significant amount of revenues very quickly. So we think it's highly likely they're going to get approved. They'll have to do a phase 3 as well. So they could probably get that done in 12 months or so after they complete the phase 2B. So we think that at a minimum, this stock should be at roughly a $400 million market cap, which is 6 times higher. Now, if somebody would come along and buy them after phase 2B, we think that it could be a $3 billion market cap and roughly $16 to maybe $17 a share, which would be an enormous move for this stock. So we don't think the stock has much downside. We think there's some really smart investors in it. They just bought a big slug of stock at 72 cents. Stock's below 50 cents. We see a big opportunity without really having any news on this. Just the overall knowledge of this stock getting out is going to push the stock up quite a bit. And then on that 2B news, we think it could be a very significant move upward in the stock after that. So as you know, I manage tactical, loss-averse portfolios. So we think it's a good time fundamentally to be defensive. The technicals are so strong, they've kind of turned negative. So we think it's a good time to be defensive as well in your core of your portfolio. So in the biotech space, my company finds the gems in the space. So I think I found a really good company here that has a really big move, really strong move in front of it. Remember, we were involved in Viking at roughly $2.50 a share. That thing's gone to $36 a share. Originally was focused on NASH. Similar to this, they found that their drug can work for obesity. So Viking shifted gears a little bit, started developing their obesity drug. We're going to see some good data out of them probably this quarter, is what they said recently. And so we think Veru is very similar to the Viking move, but it's very early stage in that movement higher. So thank you very much. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute, and we'll send it to you on a weekly basis. If there's anything we can do, again, come to my website, Patrick Adams CFA, and send me a message. Take care.